Welcome back to The Explainer. I've got my expert investment analyst hat on today, and we are going to put First Source Corporation, a regional bank operating right out of Indiana and Michigan, through what I like to call a rigorous financial gauntlet. We're not just glancing at a few charts today, oh no. We are systematically testing this stock against the legendary, time-tested frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, right before we run it through some hard quantitative valuation models like discounted cash flow. Our ultimate goal? To uncover its true intrinsic value. Okay, let's dive right into this with a totally staggering number, 38. That represents the consecutive years of dividend growth for this regional bank. Think about that for a second. In the highly cyclical, and let's face it, often turbulent world of banking, achieving nearly 4 decades of uninterrupted dividend increases immediately flags First Source Corporation as a highly resilient, cycle-tested target for our detective work. Literally, it places them in the top 2% of all public companies for dividend consistency.
So here is our roadmap for today's masterclass. We'll start with a quick company snapshot, run it through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, tackle the DCF and alternative valuations, and wrap it up with our final synthesis.
Let's kick things off with Section 1, our company snapshot, because before we unleash the gurus, we need to know exactly what we're looking at. Our starting point today is a solid $1.85 billion market cap bank, trading around $76.91 a share under the ticker SRCE. Its price-to-earnings, or PE ratio, is sitting at a cool 11.6. The company operates community banking, trust, and wealth advisory services alongside a national specialty finance group, and they are backed by a very strong balance sheet with $9.1 billion in total assets. So we've clearly got a moderately priced, well-established player here. But is it actually a buy?
Moving right along to Section 2, the Warren Buffett lens. Time to see if this company passes the strict moat-seeking philosophy of the Oracle of Omaha himself.
Buffett is always hunting for an economic moat, consistent earnings, high returns on equity, manageable debt and honest management, and, qualitatively, SRCE passes with flying colors. They command leading market share in their community banking markets. Profitability is incredibly consistent. Their return on equity is a very healthy 12.53%. And when Buffett looks at a bank's debt, he specifically looks at capital buffers. Well, First Source has a massive, historically conservative Tier 1 leverage ratio of 17.80%. To top it off, management is stellar, having been recognized on Forbes' America's Best Banks list for the 3rd consecutive year. Now, Buffett famously uses owner earnings to evaluate a business. That's essentially the cash you can pull out of the business without hurting its competitive position. Since banks obviously lack traditional capital expenditures like, say, a giant manufacturing plant would have, we're making the explicit assumption to proxy Buffett's owner earnings using their record projected 2025 net income of $158.28 million. Basically, they're generating serious, consistent cash. So what's the verdict from Buffett's corner? While SRCE is undeniably a wonderful company in his eyes, perfectly meeting his qualitative metrics for a well-managed fortress, we all know he's notoriously stingy. He would patiently wait for a steep discount to intrinsic value before ever pulling the trigger. It's a clear qualitative pass, but we need to figure out if the price offers his required margin of safety.
Let's switch gears to Section 3, the Peter Lynch lens. Before he ever looked at valuation multiples, Lynch loved to categorize companies.
Is it a fast grower, a cyclical, an asset play? Based on the hard data, First Source is the textbook definition of a Lynch stalwart. They're projecting 3.1 to 5.7% revenue and net income growth. When you combine that single-digit growth with their fortress of a balance sheet and that incredible 38-year streak of dividend increases, you get a classic stalwart. Lynch actually loved keeping a few of these in his portfolio for reliable downside protection. Now, what's really fascinating here is how Lynch would view the ownership structure. A massive 26.9% of the company is held by insiders. That is an absolute game changer for Peter Lynch. It means management's money is right there on the line alongside yours. However, the valuation does present a slight hurdle. Lynch liked to use the PEG ratio, price to earnings divided by the growth rate. With an 11.6 PE against that modest 3.1 to 5.7% growth rate, the PEG ratio is just a bit bloated. So for Lynch, this is an amazing company to hold, but perhaps not a screaming buy on growth alone. Next up, Section 4, the Benjamin Graham lens. We are going straight to the father of value investing himself to see if SRCE holds up to his strict defensive standards. Graham didn't really care for flashy narratives. He wanted deep value and strict quantitative proof.
Let's run it through his defensive investor checklist. Adequate size? Yep, 1.85 billion market cap. Strong financial condition? Absolutely. Those capital buffers are top tier. Earnings stability? Checked. Dividend record? 38 years. Say no more. Moderate PE? Yes. 11.6 is well below his usual 15x upper limit. As we mentally tally this up, SRCE systematically checks off literally every single box on Graham's rigorous checklist.
But we're not stopping there, because Graham left us a famous intrinsic value formula: the square root of 22.5 times earnings per share times book value per share. For a bank, we use tangible book value per share to be conservative. So plugging in our numbers, 22.5 times $6.41 in EPS times $49.61 in tangible book value, we get a rock-solid intrinsic value target of $84.58 per share.
And since the stock currently trades at $76.91, we're looking at roughly a 9% discount to Graham's calculated intrinsic value. For Ben Graham, a stock that meets every defensive criteria and trades below its intrinsic value provides a fantastic structural margin of safety. He would very likely consider this an actionable value play right now.
All right, Section 5, DCF and Alternative Valuations. We've heard from our qualitative and value gurus, but now it is time to strip away the narrative completely and run the hard quantitative modeling.
According to the analysis from Simply Wall Street, when you build a robust discounted cash flow or DCF model, projecting the bank's future free cash flows and discounting them back to today, it generates a massive fair value estimate of $124.61 per share. Compared to today's price of $76.91, the DCF model is suggesting the stock is roughly 38% below fair value. It's practically screaming, deeply undervalued.
But hold on, because there is a fascinating tension in the market right now. While the DCF model points to huge upside, let's look at the comparative multiples. SRCE is trading at an 11.6 PE. That is right in line with the broader U.S. banks industry average of 11.9, even though it's significantly cheaper than its direct peer group average of 16.3. Interestingly, an alternative fair PE model suggests a normalized multiple might actually be closer to 10.4. So, we have to ask, is it deeply undervalued based on raw cash flows, or fairly priced based on industry multiples? Which brings us to our final stop, Section 6, Synthesis and Final Recommendation. It's time to resolve this tension and blend all of these diverse perspectives into one unified investment recommendation. Let's synthesize our findings. The current price is $76.91. Graham's deep value formula says it's worth $84.58. The DCF model says it's worth a whopping $124.61. But that fair PE multiple model suggests a slight overvaluation, implying a price closer to $68 if expectations normalize downward. The hard cash flows and asset values point to undeniable hidden upside, but the market's current multiple pricing is acting like a gravity well dragging it down. So here is our final verdict. The bull case is incredibly strong. You've got a 38-year dividend fortress, massive 26.9% insider ownership, perfectly aligning management with shareholders, and a steep discount to both Graham's and the DCF value. The bear case? Well, it's a slow grower facing potential headwinds from tightening credit conditions, which could pressure that multiple. Balancing all of this, our synthesized view assigns SRCE a solid hold or a really strong accumulate target if the price tips closer to that $68 fair PE level, which would create a massive margin of safety for the Buffett and Lynch investors out there. We have officially put First Source Corporation through the ultimate guru gauntlet. You've seen the hard data, the legendary frameworks, and the complex valuations. Now, as you weigh these perspectives against your own investment strategy, you really have to ask yourself, is this 38-year dividend stalwart the hidden, undervalued gem your portfolio needs for long-term stability? Keep learning, keep analyzing, and I'll see you on the next explainer.